Prasad, good morning. Good to have you back on ET. Now, you've come at a time when the market mood and the market sentiment surely has changed. So, Sanjeev, my first question would be, we all know the news, the markets know the news, everybody has reacted. But do you think the price action justifies the announcement which has come from the government, or last 2 days price action is slightly more extended? Do you think the price action is in sync with what the fundamental news is, or somewhere prices have gone ahead of the news now?
Okay, see, obviously the tax rate cut is largely priced in, I would say, for the companies that can retain the benefits, which are your consumer staple companies and the global commodity companies. The key which we have to keep in mind going forward is whether the stocks which have seen a big run up in the stock prices, whether they will be in a position to retain the benefits of lower tax rates or not. And I'm not very clear whether some of the sectors which have a lot of competition, such as banking, parts of lending, for example, even automobiles, two-wheeler segment, etc., whether the companies will be able to really keep all the benefits of lower tax rate. It is possible that some company or other may take a call that they want to increase market share, and they may give, let's say, some amount of discounts on auto prices, for example, or may cut lending rates. So it is possible that some of the benefits could actually go away over time in the form of lower prices for, let's say, auto products, or for lower lending rates as far as the lending segments are concerned. Now, the other important thing is, what is the follow-up action from the government in terms of any other positive reforms? I mean, you have done one big step in the right direction, I would say, in terms of reviving investment in the country. But the important thing is, this is a necessary condition in my view for investment to take off in the country, but not a sufficient condition. So the important thing is now whether you will see more reforms in areas of, let's say, the factors of production for manufacturing really take off in the country, or some sort of strategic divestment which will get people more excited about the market. So if there is more follow-up announcements in some of these areas, then I assume the prices can sustain and even go up from current levels. So we'll have to wait and see, what is the follow-up reform measure which the government announces after the big tax rate cut which has been announced by the government.
We at ET now are picking up from our sources that the government does have a divestment roadmap ready, but let's see how and when it plays out. But Sanjeev, morning firstly, we were just analyzing the move in the Nifty and the impact that this big corporate tax bonanza has had. While the Nifty has moved up by about 8.5% roughly in the last two trading sessions, skipping today's move, which is consolidative, the average Nifty earning upgrades have come in anywhere between about 7 to 8% for the blue chip names. Would you say that for now at least the best is already in the price? 11,600 for the near term at least is a ceiling.
It looks like because this, at least the corporate tax rate cut is largely priced in stock prices, I would say. Now the question, as I was saying, was that are the companies in a position to retain the benefits or not? If over the next, let's say, next 2-3 months, if the companies are forced to pass on some of the benefits or lower tax rates in some of the sectors with a fair amount of competition, then you could see some decline in stock prices, assuming there is no further news flow from the government in terms of reforms, etc. But if there is positive news flow across the economy in terms of big reforms, then then everything will probably hold up, irrespective of the fact that you could probably see some earning downgrade as we go forward. So I don't know what the the other brokerages are factoring in. Have they just assumed that the entire benefit of lower tax rate will be kept by the companies, or in some sectors where there's a lot of competition, you may have to pass on some of the benefits. So let's see how this plays out. A lot will depend on the competitive dynamics in a sector, as also the individual strategies of companies, whether they want to keep all the tax benefits or they want to use it for increasing the market share, increasing their market position, and so on and so forth.
Example of Sanjeev, I mean, it's a great point what you're trying to express here, which is that go for companies which have pricing power. So if the tax rate cut goes down, you actually may end up retaining it. Which are the company sectors or franchise you think have strong pricing power or a moat around them that they will be able to retain all the tax benefits?
So very strangely, you have two sets of companies, one which has enormous pricing power, which are your consumer staple companies, who will obviously be in a position to retain most of the benefits because, there is not much of a competition. There are very strong moats in the businesses. And the other sector which will probably see, companies being in a position to retain the benefits are the global commodity companies with actually no pricing power. And keep in mind the fact that there the pricing and profitability is more based on global supply-demand balance. And the pricing and profitability is based on landed cost of imports. So just because there is a tax rate cut in India doesn't mean that the companies have to pass it on to consumers over here, or global prices of profitability will come down. So I would assume the oil and gas companies, the downstream refining companies, some of the metal mining companies will be in a position to retain most of the benefits. So oddly enough, we have consumer stable company with a lot of pricing power in a position to retain the benefits, and a global commodity company with absolutely no pricing power also being in a position to retain the benefits.
The other debate, Sanjeev, is also whether or not, the investment side of the economy picks up as opposed to consumption after the corporate tax rate which has come. Because what it's going to do is definitely instill a push from the private sector to spend more.
See, we'll have to wait and see because, as I said earlier, this is a necessary condition but not a sufficient condition for investment to really take off in the country. So I think the government is clearly making a pivot to investment-led growth model from the earlier consumption-led growth model. See, the government could have given the same amount of benefit which was given to companies in the form of lower corporate tax rate to the consumers in the form of lower GST rates, and there was a lot of pressure on the government to actually cut GST rates, for example, in the auto sector, etc. The government hasn't done that. So what the government is looking at is that it wants to go for investment and job creation, which I think is the right way to do it. It may take slightly longer to revive, investment and job creation and demand in turn, but I think it's a much more sustainable route, because if you're just given a one-time fiscal boost through lower GST rates, all you could have seen was that you could have seen an increase in consumption sometime. And because of lack of job creation, you could have again seen demand petering out. So I think this is a much more viable strategy which the government has adopted, but we definitely need a lot more follow-up action on this, and clearly we need some sort of much more flexible labor laws, maybe easier land acquisition policies, but I'm less worried about it because land is generally available, and I think if you pay the right price you can get the land, and maybe easier approval processes. So if the government fixes some of these things, then we are off to the races. Then I think investment and manufacturing investment can really take off in the country.
I'm sure your foreign investors are calling you. Some who have missed the bus on Friday, some who did not participate on Monday. Now they're staring at an underperformance because the index is up 8%. What are you telling them? Chase, protect your performance, or wait for a bad day? Earning season will not be great, crude is volatile, you will get a bad patch, that's the time you will get a time to come back in?
See, as you also mentioned, some of this is largely priced in. So whatever, stock reactions you have seen, that is more or less equal to the tax benefit. In some cases, you have seen much higher stock price reaction compared to the extent of improvement in the upgrades and earning numbers. So I think it may not be a very smart idea, chasing everything now, but definitely things have changed for India in the sense, let's say a week back, you had a situation where India was looking down the barrel in the sense you had a GDP growth which was, clearly, slowing down significantly. You had chances of big earning downgrades. So earlier, before the corporate tax rate cut, we were looking at 15% growth in net profits of the Nifty 50 index. That would have gone down to, single digits in my view. And you also had a risk of derating of the market. Assuming GDP growth wouldn't have picked up and you had earning downgrades, you would also see the derating of the multiples of the market. But thankfully now it looks like we have put a floor to the negative sentiment, in the sense we have seen actually earnings upgrades instead of earning downgrades because of the tax rate cut. And also now there is a lot of hope and expectation that investment cycle can take off, the economic growth can revive, and so on and so forth. So I think the multiples sustain. But let's wait and see, what's the follow-up action. If there is no follow-up action, then maybe the stock price will start, coming off a little bit, because a lot of good news is now getting priced in. But if there is follow-up action, then I think, you just stay invested basically, and you ride the, the good news which will come. You, in a sense, you will still see earnings upgrades in some cases, and possibly multiple re-rating in many of the beaten down stocks. For example, if you actually see strategic divestment, I think many of the PSU stocks could be a lot higher compared to where they are. So let's see how the government takes the opportunity to really make this once in a lifetime opportunity, which is there for India. And also on the divestment route, I think somewhere the government needs to start thinking more on the strategic divestment route rather than on this ETF or the inter PSU transfer which the government is doing so far, because that really results in a lot of value destruction. So I think if the government has bigger objectives of bigger infrastructure spending in the country, as a foundation stone for getting to $5 trillion economy in 5 years' time, I think the government needs money from somewhere, and one of the easier way out is just privatize some of these companies. And don't need to privatize by selling through the strategic route. You can just privatize the companies by just bringing down the government holding to below 50%. Many of these companies are in accredited businesses. They have reasonably smart management. So you just put a good board over there, so they can be board and professionally managed companies, and the government can actually raise a lot of money through this route. Because if you look at the value of government holding in these companies above 51%, that is actually only worth 1 year of divestment revenues, by the way, if you exclude the banks. And if you include all the indirect holdings of the PSU and LIC, that is actually equal to 2 years of divestment revenues. So somewhere I think the government has to look at strategic divestment, which could be just privatization. Let me put it that way: privatization route, which could be strategic, or it could be a normal privatization. Just basically sales to retail institutional investors. So I think the government will have to start thinking on those lines, because we only have 2 years worth of revenues which the government get from divestment through the normal route as of now.
Many believe the time has now come out to switch out of the traditional defensives, which up until Friday morning were the only hiring places, IT and pharma. Would you also make changes to your estimates, and do you recommend an avoid or a profit take when it comes to IT and pharmaceuticals?
See, the valuations are quite reasonable over there, and it is not as if India is out of the woods completely. I mean, we have done one great step in the right direction. I mean, we need a series of more actions, I would say. So let's see how things evolve. But yeah, at the margin, maybe one could be maybe slightly more neutral on IT and pharma compared to some of the other companies which probably benefit a lot more from the tax rate changes. But the thing is, it's already priced in, so what's the point in doing the changes now, basically? So I think we might as well leave it for the time being, and let's see how things evolve.
Sanjeev, would you everyone's been looking at a best case scenario. On all fronts, it seems to be best case. But just, if we don't happen to see the follow-up, if we don't see the kind of results in the earnings coming through over the next couple of quarters, is there anything that you're pricing in or factoring in rather, with regards to, possibly things not living up to the expectations?
You still have a lot of global related issues which, could go wrong. I mean, China, US issues, there is this trade settlement looks like, they are blowing hot, blowing cold. You never know, what's going on over there exactly. So that issue is still very much open. Then you have the oil price issue, thankfully things are getting back to normal as far as Saudi supply is concerned. But obviously you have a lot of, tensions out there. One wrong move on the part of any of the actors over there, and you have, a real problem on oil prices. So that way, India has been very lucky that despite all the, geopolitical disruptions which we have seen in oil, Venezuela declining, Iran oil exports out of the market, an attack on Saudi's main, oil processing facility, oil is still, reasonably priced. So in a way, the gods are in our favor. We have good monsoons, we have inflation under control, you have oil price under control. The government has done a very big, bold move. I mean, do a few more things, and as I said, we are off to the races.
When do you think autos will genuinely show signs of recovery? What may happen in October could be base effect, but that's not recovery.
No, I think this will take time, because, government has not given any short-term boost to the economy. So I don't know. I mean, this is going to take longer than expected to revive. So, I guess, that's the strategy the government has also adopted in a way, it is classic, in a way, trickle down economics working. One thing was you could have just given a big tax cut, across the board and, assume a demand pickup and, that itself driving, supply, creation and so on and so forth. But the government is taking a route, that we will go down the investment route and create jobs and then maybe demand comes. So I think this is demand is a follow-up now of investment basically. So this will take time.
Let's talk about the odd one out. And the odd one out, Sanjeev, is going to be IT. Do you think IT stocks, which have been used as more like a safety shelter by institutional investors, that safety advantage will go away from IT?
Hard to say. As I said, one wrong move in the Middle East, oil prices go up, IT comes back into favor, rupee depreciates, so these you have to have a balanced portfolio, to put it this way. I don't take very extreme positions because you have so many things which could move, against you or for you, depending on how you are positioned. So if you are very strongly aligned towards certain set of stocks, assuming that particular event will play out, I mean, markets don't work way, economies don't work way that way, so it is all a probability game. There is a probability of various events playing out, and accordingly you take a call, you position your portfolio accordingly. So I think it's best, to have some protection always in the portfolio, for things which could go wrong basically. Who knows?
Sanjeev Prasad, for the first time, he used to track Reliance, which was only a petrochemical company. Then it became a telecom company. Then it became a E&P company. Then it became a retail company. Now it's become a big data company. How would you view Reliance? I mean, what is Reliance and what is the right valuation to give to Reliance now?
No, I think the way you have to look at Reliance is a company with a past which is more in global competitive businesses, which is moving to more future-proof businesses. And I think that's a very, very smart move on part of the management. Because I think the management clearly understands that something like refining may or may not have a future in 20 years' time. If fossil fuel in demand starts peaking sometime in 2040, which is what most people keep talking about. So use the cash flows of the petrochemical refining business to build a more future-proof business, which is basically e-commerce, retainment combination. So they clearly, they understand this and clearly on the right path over there. Now, valuation over here is that you could do a simple sum of the part basis. You would get to somewhere about 1400, which is where our FAME value is. Or you could also look at this company as, something which could be beyond the sum of the part basis, in the sense, there are a lot of opportunity which the company could still exploit in India, based on the platform which it is creating. How to value that, I don't know, it's a difficult task. So at 1250, you stay invested in the stock. That's how I would look at it.
As always, thanks so much for taking the time out.